Hello and welcome to today's video, which is going to be highly practical for intraday traders and swing traders paying attention to macroeconomics fundamentals alike. I will dive what I had done and how I had prepared clients for the upcoming moves in equities and precious metals in relation to what yields are doing and what I saw them being projected to do based on my reading of macroeconomic data of the US economy and its outperformance versus the rest of the world. So today's video is called How I Timed SPY and Gold Crash and the reaction to the incoming JOLTS data and services PMI had been truly a violent one. So let's dive into the details. Thank you for liking this video, it helps greatly with the algo, and subscribing to the channel so that you are kept up to date whenever I post a fresh content to the YouTube channel. You know pretty well my site and the dedication one-on-one that I'm delivering to clients, starting from trading signals ones, which are focused on all inclusive analysis spanning across the markets and get the priority support. So this is the situation on the 15-minute chart before the data release earlier today. You can see very tired upswing and hesitation right off the start. Inability to extend gains and just barely hanging in there. That's the S&P 500. Pardon me, but one would expect a better showing following the CS event starting yesterday from Nasdaq, but that has not been the case. It's been already quite peculiar that during the latter two-thirds, roughly speaking, of the regular session yesterday, the upswing starting pre-market in the Asian hours Monday had been sold into this much, and you can really see that there is no outperformance of tech versus S&P 500 to speak of, which is a sign in itself. So this is as well how it looked in tech before rising. A few words about Nvidia. Sure, attacking 150, opening 153 roughly, is a great achievement following yesterday's rejection that left a long upper knot on the daily chart. But no matter how important this company is, it can't power the whole index all the time, and there have been some signs, as we will later on in this video see, of creeping deterioration in the chart. So moving on to Russell 2000. The upswing kind of indicated that there would be that there was an implicit build-up of expectations erring on the side of rate cuts sooner, meaning that the expectations were quite lofty. But have you seen me talking about negative economic surprises when it comes to US with this volume of international monetary inflows into US equity and bond markets? Not at all during latest months, when I had been steadily backing practically every quarter the recession calls and disregarding some rule triggers, yield curve inversion and what have you, bankruptcies and rising delinquencies on credit cards and so on. I doubted that, because one look at consumer discretionaries was enough, that the US consumer is underappreciated and is actually stronger than it seems. And this Russell 2000 chart reflected the expectations and celebration and positioning for rising rate cut odds, as much as gold did, which was part of my other criticism that I delivered before the data release to clients, and later on as well publicly on Twitter, when I was doubting that some rumors of People's Bank of China resuming gold purchases would be enough to keep the yellow metal well bid. And you have the charts open as we speak and see that gold had tanked likewise, and that's why I was not betting on 2700 beat, and rather on the next considerable move being to the downside. Yeah, sure, I get it, and I am a long-term gold bull, but the odds are arrayed against precious metals in the near term. True, with China stimulus expectations hitting the wires late Friday on the weekend, it's a little changed and gave a fresh upswing impetus to silver and copper. But is that enough? Is that enough for a lasting reversal? In these economically sensitive metals, the situation is somewhat different than in gold, so that's why I concentrated on calling gold downside rather than too much silver downside, outperforming gold downside today or in the days to come. So that was a long excursion to real assets, so that you can see what kind of services, trading signals clients are getting, and it's so ideal for you to turbocharge your learning curve and own success in having access to the quality daily analytics coupled with brief intraday calls within the intraday channels. So I highly encourage you to make the most of what I do for you. One quick look, chart-driven look at the short-term yields chart. We see these treasuries retreating, declining, which means that short-term yields are rising because the relationship is inverse and the pattern is clear: lower highs and lower lows. This is what I call eating through supply. All the upswings are being clearly rejected. Those two upper knots are clear signs of rejection, as much as what we saw yesterday at the red 200 line. So the table was slated for yields to rise because that's the story that this chart tells. And now, when the news of lower JOLTS quits and higher JOLTS openings, coupled with a beat in services PMI. Services are the dominant sector, dominant part of the US economy. Meaning, where is the impetus for Fed, the reasoning to cut, to hurry cutting, when conversely Fed speakers from daily to yesterday's array had been cautioning against getting lulled to sleep in the inflation fight, and correctly so. correctly so, and they have now one less reason to be cutting with all the new admin policies expected to turn up the wheel of inflation again. That's one thing, but I'm leaning towards more of a deflationary scare hitting us within the first quarter, and of course it would not emanate from the States, which is the best functioning part of the world economy at the moment out of the major ones. So that was the bond market situation before the data release, and now this is switching to hourly chart. S&P 500 after the release and the initial dust kind of settling. In this context, it makes so much sense to prepare oneself with the levels, potential areas of interest, when and where exactly these may hold, which means for ES that's the little bit below 6,010 level, and then the low 5,990s. These would be two areas of interest, and it makes great sense to follow on a, say, 5 or 15 minute chart how various sectors and intermarket characteristics are doing. So the correct macro predictions about strengthening the not at all dovish upcoming Fed policies paid off, and a downswing in equities across the board, of course heavily hitting Russell 2000 as well, had been achieved to the benefit of clients, whether they are swing, and they had been cautioned to focus on one of these two support areas, or when it comes to intraday active clients, which had been presented my most likely scenario of S&P 500 and Nasdaq going downhill since the pre-market pump into the data release, and then it hit with full force thanks to the data being aligned and the market interpretation thereof being aligned with what makes most economic sense for asset prices to do given the strong performance of the US economy. Note as well where the relative peaks in and troughs in S&P 500 on this chart, and on the following, sorry, it's not included in here, but if you fire up your own Nasdaq charts, you see creeping underperformance of Nasdaq, which is very visible pre-market, and that is what I showed you on the 15-minute chart on chart number 3 or 2 in this video. So there you have a precise look, but pay most attention to the gap sending yields even higher and short-term bonds lower, and this is what's driving the markets, most of all the interaction between yields and the dollar at the moment, how it affects various indices in different ways, and what are we going to do about it as traders or investors. If we wanted to dip our toes, then the correct choice had been what I had presented to clients in our intraday channel yesterday, and that was the Russell 2000 short, bringing in 16 points within a couple of hours with barely any adverse excursion, meaning sending us to open loss that was reversed and ended up with a solid closed gain for call. So that is what yields did after, and remaining with gold, where I doubted the pre-market steep ascent into the US Open, where it started to hesitate somewhat in the final minutes before the opening bell. Here you can see how gold is weakening, and the next couple of hours will be very insightful about the degree to which the sellers are able to resume initiative, and I do see them as the stronger side. Yet it remains to be seen simply how much the dollar is going up at the moment, what yields are doing, and whether we see any kind of panic in equities stopping or not. But the call for gold to be checked and to sink had been fulfilled, and as well the reason was correct macro reading of the US economy. So this is just a brief example with plenty of side explanations, how I think about how I approach the markets and how I use all the information and experience to help you, to help clients succeed, because success of each of you, whether you are client for years or a fresh one, is very important for me, and I want to see you growing and beating it in the markets, whether you trade zero-dated options, as some of you do, or are with futures, or long-term investors that are short on time. I take care to tailor individual solutions fitting your needs, so you can always talk to me directly, and I look forward for receiving your messages. Thanks again for liking this video, subscribing to the channel with notifications on. Obligatory disclaimer, you know my professional journey and this visual, let's call it visual